Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. I want to welcome you once again to a subscriber request Tuesday video where I'm going to cover Hewlett Packard Enterprise Company, which was originally in 2015 spun off from Hewlett Packard, which is better known at the time for its printers and its hardware business. So this is kind of the cloud version of Hewlett Packard. So let's go directly into FastGraphs and take a look at the company. And there's some very intriguing elements about this stock that I find very interesting. Let's start by just looking at it from a pure valuation point of view. I want you to note that the company's earnings growth has averaged just under 9% a year, 8.9% since it went public. And that included the COVID issue where they actually had a negative earnings growth of 24%. The company's stock price has tracked earnings, but it's done it at a very low multiple. The normal PE for this stock, or the market PE, has only been about 8.9 times earnings, or less than 10 times earnings. That's what the blue line on this graph is suggesting. So the company is not being valued very aggressively by the market. I think that's a long-term plus on this stock. You can currently buy it at a 7.64 blended PE, which again is below the 8.91 historical average. But despite that, the company's performance since it was spun off has averaged just under 14% per year. So it's been a good investment, and it's not really being valued very properly, at least in my opinion. The current dividend yield is 3.27%, and the earnings yield is over 13%. That is something I'm very, very attracted to. Now, let's look at some of the other metrics here on the company. Let's look at diluted earnings, which includes accounting convention. You can see there's been a lot of accounting convention included in their diluted earnings, and you'll see a much different PE ratio if you're looking at diluted earnings. For those of you who don't get why the PE ratios are different when I do these videos than you might see on Google, is because they're probably using the GAAP numbers. But even under GAAP numbers, which is diluted earnings, the company doesn't look too bad right here. But there's been a lot of accounting convention. So let's move on then to cash flow. Let's look at operating cash flow. Operating cash flow has been very strong for the company. I'm going to shorten the time frame here. It's averaged about 15% a year since the beginning of 2016. Now, it's been moderately cyclical, but one thing I do like about operating cash flow here, it's covered the dividend, essentially over this entire time frame. And once again, the valuation is only trading at a price to operating cash flow of about 5.1, and it's typically been trading at about 6.8. So the company looks very stable and very strong on a cash flow point of view. And then free cash flow, which is ultimately the litmus test, the company did have negative free cash flow in 2017. During COVID, free cash flow barely covered the dividend. In fact, it didn't quite cover the dividend, but it's been building up again. So these are some things that I think you need to be taken into consideration. If you look at Ebitda, the company looks very, very cheap, trading at only 3.7 times Ebitda. If you look at operating margin, or EBIT, the company also looks very, very inexpensive, trading at about 6.7 times EBIT, and it usually trades at about 10 times EBIT. So, no matter how you look at it, and finally, if you look at it from a price to sales point of view, its typical price to sales has been about 0.8. It currently is trading at 0.7 times sales. So, all in all, I think it's very arguable that the company is very inexpensive at these levels. That's something that's, real important. It is paying a nice dividend. Now, if you note, the company did freeze their dividend coming out of COVID, but they did pay it. And they're expected, to raise their dividend slightly again next year and the following year. But currently, they're at a dividend of 48 cents. And not expected a lot of growth in that dividend. But it does offer a 3.27% dividend yield with a 13.09% earnings yield, which I find very, very attractive. And, as far as the distinction between the companies, this is basically a cloud-based company. So let's go into the external links and look at the company from the standpoint of their corporate website here. So if you go into, Hewlett Packard, you can see that it's kind of complex. I'm going to tell y'all I'm not an expert on this company, but they do provide a lot of services and solutions for people on their cloud platforms. They have workload optimization products, solutions, and services, data storage, compute, networking, software, etc. So it's a pretty interesting company. Now, according to Zacks Investment Research, the company really has a lot of promise. They give several reasons to buy. One is they say after the split from the parent company, they have made it clear, HPE has made it clear that it will focus on restructuring and realigning its business to drive long-term sustainable growth and improve margins. We're going to take a look at that here in a second. So to do that, let's go ahead and get into the fund graphs and go through the process that I like to go through when I'm analyzing these companies and to see the good, the bad, and the ugly that we come up with here. Now, I've created a 17-point program. It's evolving, and by the way, we're developing that allows me to evaluate these companies based on very important fundamentals. So I'm going to go into the in millions graph here, and I'm going to go into the income statement. The first thing I want to look at is shares outstanding. I'll do both basic and diluted, which essentially are very, very similar or almost identical. I do want you to note that the company, actually, if I look at it from the full term, you can see that since about 2015, they've been buying back their shares rather aggressively. They've gone from 1.7 billion shares to under 1.3 billion shares by the end of October 2020. So that has had an effect on some things that I'll get into. But the point is, they are buying back their stock. Now, if I look at cash flow from operations being higher than net income, that's another thing I like to see. So I'm going to go ahead and go into the in millions graph here. I'm going to go into the income statement. I'm going to look at net income, and then I'm going to look at going into the cash flow statement and look at operating cash flow. And what I want to see here is operating cash flow higher than net income. Now, it is higher than net income, but I also want to point out that, last year the company had negative net income. And so that's kind of a bit of a red flag. That's something that you would want to look at and check. And so the next thing I'm going to look at is I want to look at sales and revenue growth. So I'll go ahead and look at sales and revenue growth. And once again, I see that revenue growth has been weakening for the last 2 or 3 years, but it's generally strong and good. Now, another way to look at that is to go into the per share revenue growth. And when you look at per share revenue growth, you see it's a lot more positive looking than what you did on gross. And that has to do with the company buying back the shares that I covered here a moment ago. So they are generating revenue per share growth. And as a shareholder, that's important because you own shares of the company. And by buying back shares, they're giving you a bigger call on the business of the company and on the revenues of the company. So, when I look at that, I see that. Now, I can also look at, net income growth. I want to see what net income growth looks like. And again, I've got negative net income. It's been falling rather dramatically. So let's look at net income per share, and we still see a negative trend here. So, this is something that I'm a little bit concerned about that, I want to understand that a little better. Now, the debt to equity ratio, which I'm going to move into the ratio graphs here and look at the debt to equity ratio. And what I'm going to determine, what I see here immediately is that the company's debt to equity ratio of 0.81 doesn't look real intriguing to me. So let's look at that a little closer. Let's go into the millions graph and let's look at total equity by going into the balance sheet here. And let me clear a little bit here. And let's go ahead and look at total equity. And then let's look at total debt. And what we discover is total debt is higher than equity, which means the company has a negative net equity, if you will. And that's, again, an issue. Now, I talked about margins before, so I'm going to go back into the ratios graph, and I'm going to look at gross and net margins. And once again, I see something here that's a bit troubling. The company's actually, in 2020, had negative net margins. They did maintain good gross margins, but they had negative net margins. So that's something I'm a little concerned of. If I look at sales revenue versus total assets, so I'll go back into the millions graph, and I'm going to look at sales and revenue. And what I want to see is I'm looking for asset turnover here. So I'm going to then go into the balance sheet, and I'm going to look at total assets. And let me get rid of the total debt here so this is clear. And they're not really turning over their assets, what I would call in a great ratio. But the bottom line is that they are turning over their assets somewhat. If I look at returns on assets, and I go into get rid of my gross and net margins here and look at return on assets, they've got a negative return on assets, which again is troubling. So that doesn't, make me feel real good about the stock there. As far as return on equity, since the company has negative equity, they also have negative return on equity, again, which is another negative I would see with the company. But again, a lot of that has to do with the fact that they've been destroying equity by taking on debt and buying back their shares. And that sometimes can be okay if I'm looking at it in the long run. I'm going to finally go to operating earnings margin, which is EBIT divided by sales. So I'll go once again into the millions graph, and I'll take EBIT and divide it by sales. And what I do get here is I get a pretty good, ratio here. The company is generating a pretty good margin relative to their sales. So, that all in all looks fairly well. But the point is the company is growing their business. Their sales, if I go back to the operating sales here, their sales have flattened in recent years. So, there's some issues about looking at this company and probably illustrates why the market has been valuing it so low. So let's go ahead and look at what we might expect to earn from this company. Now, by the way, it is BBB rated, which I like. The company's forecast to grow earnings at a rate of about 13.5%, but that includes a very strong year this year, with then coupled by 5% going forward. So I don't really see a lot of sales growth going forward. If I look at their normal multiple of 9 times earnings, that would still give me a pretty strong rate of return for the next couple of years. And of course, if it ever returned back to like a more normalized 15 PE, the rates of return would be exceptional. But there are some issues here that I believe investors need to look closely at before they take a position in Hewlett Packard Enterprises. Now, there are positives about the company that I think are worth talking about. They're involved in the Internet of Things and artificial intelligence. That's something that, is considered decent. As far as, according to Zacks, they could be considered as a below average leverage company, as their current total debt to total capital of 0.42 is significantly lower than the industry average of 0.64. So that's possibly, there's your debt to capital. That's maybe a positive if you want to look at it that way. But, it's an interesting company. It's got interesting potential. It's got some good statistics. It's certainly inexpensive and maybe worth speculating on. But I do think there are some concerns here about some of those negative numbers I showed you when I went through the financial statements that I believe you want to check out and kind of look into if you're going to take a position. The only thing I think really going for this stock is it's cheap, but the market has continued to keep it cheap. And that's something I think you also ought to factor into your logic. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this subscriber request series. I don't know as much about this company as I would like to. I am going to look into it a little more. The one thing that I am intrigued by as Mr. Valuation is its low valuation relative to earnings and cash flow. So the real key is, what's the company's future going to look like and what can I expect here? But that's going to take a lot of work on both my part and hopefully yours. Anyway, thanks for watching. Hope you enjoyed the video. If you did, give me a like, ring the bell, subscribe to the channel if you haven't already. You might want to take a closer look at the Fast Graphs Fundamentals Analyzer software tool as well. Thanks for watching.